Hello all, good morning. I am Sneha R, Assistant Professor from Dayanand Sagar College. Today I'll be discussing a topic regarding principles of bank lending. So before going to this topic, let us know who is a lending banker. A lending banker is a person or a banker who lends loans and advances to his customer. So he is the one who is providing financial assistance to his customer. This financial assistance is not provided for free of cost, so he is providing at an agreed rate of interest for a specified period of time. So what are the topics for discussion under principles of bank lending? 1. Loan. 2nd, cash credit. 3rd, overdraft. 4th, bills purchased. 5th, LOC. Types of securities, NPA, and sound principles of bank lending. What are the different types or kinds of lending facilities? Number 1, loan. Loan is a lump sum amount which is granted by the banker to the customer for a specified period of time at an agreed rate of interest. It can be of short term, medium term or long term. If the loan has been granted for less than 1 year, that comes under short term. If the loan has been granted for a period of 1 to 5 years, that comes under medium term. And if it has been granted for more than 5 years and the period may extend to 25 or 30 years, that comes under long term. So here the interest will be charged on the full amount sanctioned. Say for example, as a banker he has lent 5 lakhs to me and I have withdrawn only 2 lakhs. Here the interest will be charged on the full amount sanctioned. So he will be charging interest on the complete 5 lakhs. He will not be charging interest on the amount withdrawn or whatever the balance which is remaining in my account. Remember, the interest will be charged on the amount sanctioned. Second, overdraft. Overdraft is a facility which is given to the current account holder. Overdraft refers to drawing over and above the balance of the account. Your interest will be charged on the amount overdrawn. Current account holder, he will be paying commitment charges. So remember, what is overdraft? It refers to drawing over and above the balance of account. Say for example, I am having 30,000 in my account. I need 20,000 under overdraft facility. As a banker, he'll be providing overdraft facility of 20,000. So I am liable to pay interest only on the amount overdrawn, that is on 20,000 rupees. So I will not be paying interest on my amount. Whatever I had in my account, it was 30,000. I need not pay interest on this 30,000. I will be paying interest on the amount overdrawn, that is rupees 20,000. Cash credit. This is a facility which is given by the banker to the customer against security. So you have to give any surety or you have to give any collateral so that as a banker he'll be granting loan to you. Say for example, if I need a loan of rupees 5 lakhs, I'll be pledging my property worth 10 lakhs or 8 lakhs to the banker, then he'll be granting loan to me. So here the interest will be charged on the amount withdrawn, not on the full amount sanctioned. See, we have a difference between loan and cash credit. There, the interest was charged on the full amount, whereas here the interest will be charged on the amount withdrawn. Say for example, 5 lakhs amount has been granted to me, where I have withdrawn only 2 lakhs rupees. So here the interest will be charged on the amount withdrawn, that is here interest will be charged on 2 lakh and not on the complete amount 5 lakhs. So that comes under cash credits. Here as a customer you have to provide collateral or surety to the banker, then only he will be granting loan to the customer. Next, bills purchased. So this is a facility which is given by the banker wherein he collects the bill and he provides immediate cash at a discount rate. Say for example, as a banker he has collected 10 lakhs worth bill from you and he is providing 9 lakhs immediate cash at a discount rate. So here he is providing you 9 lakhs cash. The 1 lakh which is remaining is a profit for him. What is bills purchased? Here as a collecting banker or as a banker, he collects the bill from the customer and he provides immediate cash at a discount rate. That is said to be bills purchased. Next is LOC, that is letter of credit. Letter of credit is a guarantee letter. It is issued in case of international trade. This is a letter which is drawn in favor of exporter at the request of importer. I repeat, so here we are having 4 keywords. This letter of credit is nothing but a guarantee letter. So when this letter of credit will be issued? Only in case of international trade. For domestic trade and all will not go with this LOC. And then in whose name this letter of credit will be drawn? The letter of credit will be drawn in favor of exporter. So who is requesting to draw this LOC? It is the importer, to the importer's bank. Remember, letter of credit is a guarantee letter which is issued in case of international trade. Here LOC is drawn in favor of exporter at the request of the importer by the importer's bank. What are the different types of LOC? We have first one, documentary and clean letter of credit. Documentary letter of credit is also called as secured letter of credit. In order to honor the bill, the issuing bank requires certain documents such as bill of lading, issuing policy, invoice, certificate of origin. Whereas in case of clean letter of credit, without producing any documents, the issuing bank will honor the bill. That comes under clean letter of credit, which is also called as open letter of credit. Revocable and irrevocable letter of credit. The letter of credit which can be cancelled by the issuing bank without the consent of the beneficiary. Beneficiary is the exporter here. So the letter of credit can be cancelled by the banker itself. That comes under revocable. If the letter of credit cannot be cancelled by the banker without the consent of beneficiary, that comes under irrevocable. Which can be cancelled, which cannot be cancelled. Revocable and irrevocable. Fixed and revolving letter of credit. A fixed letter of credit is opened for a specific amount. The exporter may draw the bill more than one time. So the credit would get exhausted as soon as the total amount has been withdrawn. We can draw the bill till the credit amount it gets exhausted. Revolving letter of credit is a letter of credit wherein the amount of credit remains constant. When a bill is drawn, the amount gets reduced, which means that the bill has been duly honored and the credit amount is automatically renewed. So that comes under revolving letter of credit. Next is confirmed and unconfirmed letter of credit. If the word confirmation has been added to the letter of credit, that comes under confirmed letter of credit. If a letter of credit does not carry the word confirmation, that comes under unconfirmed letter of credit. So who will be adding this word confirmation? The exporter may ask the importer to open a confirmed letter of credit. In such case, the importer has to request his bank to open a confirmed letter of credit. The importer bank then would request the exporter bank to add the word confirmation to the letter of credit. And the exporter bank does so. So here the exporter bank is the one who is actually adding the word confirmation. Okay. Next is with and without recourse letter of credit. In case of with recourse letter of credit, if the bill is dishonored, the exporter holds liability. In case of without recourse letter of credit, if the bill is dishonored, the exporter will not bear any liability. So in both the cases, the bill has been dishonored. And if the exporter holds the liability, if he is ready to take up the risk, that comes under with recourse. If he does not bear, if he does not incur any liability, that comes under without recourse. Next is green clause letter of credit. This is a clause or this is a letter of credit which allows the exporter to get finance for warehousing and insurance charges at port where the goods are stored pending availability of the ship. So here he is getting finance mainly for two purposes, that is warehousing and insurance charges. Traveler's letter of credit. So this is a letter of credit which is issued for the convenience of traveling public. So this is issued by the banks mainly to avoid the risk of loss or inconvenience in carrying large amount of cash. This consists of both LOC, letter of credit, and letter of identification. Next is transferable and non-transferable letter of credit. The letter of credit which can be transferred from one person to the other. That comes under transferable. Name itself it is suggesting you can transfer from one to another, one to anybody, any party, that's any third party. So that comes under transferable. Non-transferable, the letter of credit which cannot be transferred from one person to other is said to be non-transferable. Back-to-back letter of credit. So here, as an exporter, if he has received a non-transferable letter of credit, he cannot transfer it to his supplier. In this case, what he'll be doing, he'll approach his banker, that is exporter's bank, to issue or to open a new letter of credit in favor of his supplier against the letter of credit which has been issued in his favor. So this is back to back. The name itself it is suggesting back to back, one after the other. See, as an importer, I have drawn letter of credit in favor of exporter. Exporter is drawing a letter of credit in favor of supplier. That is back to back. As he has received a non-transferable letter of credit, he cannot transfer that letter to his supplier. So what he is doing, he is asking his banker to draw or to open a new letter of credit, considering the letter of credit which has been issued in favor of him as security. So remember, what is back-to-back letter of credit? Here, the intermediary or the exporter has received non-transferable letter of credit. In this case, he can request the banker to open a new credit in favor of supplier on the security of letter of credit issued in his favor. Such a letter of credit is called as back-to-back letter of credit. Next, and the last is red clause letter of credit. Red clause letter of credit is a letter of credit which appears in red ink. Red ink. So here, this is a request which is made by the importer's bank to the exporter bank to grant finance to the exporter before shipment of goods. So if you are an exporter and if I am an importer, I am in India and you are in US. In this case, you have not sent goods to me. Before the shipment itself, you are getting finance. So this facility is provided by the exporter's bank at the request of importer's bank. Okay, so that comes under red clause letter of credit. What are the different types of securities? Number 1, mortgage; second, pledge; third, assignment; fourth, guarantee; and fifth, hypothecation. So as a banker, before lending loan to the customer, he requires some security. It can be in the form of surety or any collateral which will be provided by the customer. That comes under types of securities. It can be in the form of mortgage, pledge, assignment, guarantee, and hypothecation. So let us know what is mortgage. This is a legal agreement by which a bank lends money at interest in exchange for taking title of debtor's property with the condition that the delivery of title becomes void upon the payment of debt, which means that there is a legal agreement between the banker and customer. So as a customer, he is exchanging the property to the banker. In case if the customer fails to repay the loan amount, the banker he reserves the rights to hold or to sell the property. If the customer repays the debt amount, then the agreement it becomes void. That comes under mortgage. Let us know what is pledge. Pledge is a bailment agreement between the debtor, pledgor, and creditor, pledgee, to secure repayment of debt. So pledge is used when the lender, that is pledgee, takes actual possession of assets. Next is assignment. Assignment constitutes an action taken with a contract. Assignment occurs when the owner of a contract known as the assigner gives a contract to the other party known as the assignee. The assignee assumes all the responsibilities and benefits of the contract. Let us take an example of LIC. I can pledge this LIC policy. Then I can take loan. I can borrow loan considering or providing this as collateral. In such case, in the event of death of the assigner, the assignee is paid first and the balance, if any, will be paid to the policy's beneficiary. Say for example, I have taken LIC policy. I'm the owner of the policy, so I'll be called as an assigner. The one who will be getting benefit is my son. So he's the policy's beneficiary. Okay. Next is guarantee. Guarantee is a promise which is made by an outside party to repay a debt if the debtor default on the loan. So this is a promise which is made by the outside party. Say for example, if you are taking loan, if you want to borrow loan from the bank, you are giving my name. You'll be telling me to give surety. So this is what is guarantee is. So I'll be signing saying that in case if your customer fails to repay the amount, I am liable, I am bound to pay the loan amount. So this is what is guarantee is. So in this case, it is a promise which is made by the outside party to repay a debt if the debtor default on the loan. In case if you fail to repay, then I'll be liable to repay back the amount. That comes under guarantee. Hypothecation. This is a practice where a debtor pledges collateral to secure a debt, or as a condition precedent to the debt, or a third party pledges collateral for the debtor. See, one and all it is same. It is very much similar. One is mortgage, pledge and hypothecation. Okay. Now let us know what is NPA. NPA stands for non-performing assets. The assets which do not earn any income for the banks is called as non-performing asset, or else a non-performing asset is an advance where the interest and principal amount remains unpaid for a period of more than 90 days in respect of a loan, overdraft, cash credit, etc. So remember, the principal amount and the interest has not been paid by the customer and banker has waited for more than 90 days. So this will be treated as non-performing asset. See, as a banker, he is providing you the cash facility, right? Cash is an asset. So he has granted loan to you, but he is not getting any benefit out of it. He is not getting the principal amount. He is not getting the interest, which comes under non-performing asset. It is not generating any income for the bank. So this is said to be NPA. What can be the factor for this NPA? We have divided it under internal and external factor. We also can include points under other factor. So let us discuss the factors for NPA. One is internal factor. It can be inefficiency of management, inappropriate technology, business failures, diversion of fund. External factors can be which is not under the control of the financial institution. It can be recession in the economy, rising in prices, exchange rate fluctuation, natural calamities, changes in government policies. We also can include other factors which considers poor monitoring of credits, liberalization of economy, mismatch of funding, high cost of borrowing. If the collection of debt is very slow, even this also acts as a factor for NPA. So we got to know the factors and about NPA. Let us know the impact of NPA then. The major impact of NPA on banking sectors are on profitability. See, what will be the profit for the bank? It is the income what they receive out of interests. So, as a banker, he is receiving interest which acts as a profit for them. So, why do they need profit? So, as a banker, they need profit mainly to meet expenses, also to pay dividend to their shareholders. It leads to economic slowdown. Again, it also tells about the poor liability management. It impacts on the capital adequacy. Again, the shareholder and the public, they'll definitely lose confidence. They don't want to invest on particular bank. If they're not performing well, it's for sure that as a customer, we don't want to invest on particular financial institution. So all these impacts, we can just find it on the banking sectors. The next concept is sound principles of bank lending. So we have discussed as a banker before lending loan to the customer, he'll consider certain factors. So what are those factors? So those principles. One is safety, liquidity, profitability, security, purpose of loan, diversification of risk, assured repayment, social objective, LLA, which is the Law of Limitation Act, recent concept of sound lending. Recent concepts of sound lending. So what is safety? Safety first should be the guiding principle while granting loans and advances. So as a banker, he has to make sure that there is a safety for the funds which has been lent. He also has to ensure that the advances come back in normal course. So that comes under safety. As a banker, before lending loan, he must make sure that he'll be having an assured repayment. He is having a security. The 3 C's will consider character, capacity, collateral. So he must make sure that there is a safety. The amount which has been lent, he can receive it again in a normal course. That comes under safety. Liquidity, easy convertibility to cash or easy availability of cash without much loss in its value is liquidity. So banker has to repay amount on demand. Correct. So he has to maintain enough balance. And whatever the asset which has been pledged, the property which has been pledged by the customer, as a banker, he has to convert the same asset to cash without much loss in case if the customer fails to repay the debt amount. So whatever the asset which has been received by him as collateral, he must make sure that he can easily convert it to cash without much loss. That comes under liquidity. Profitability, as I've already told, the main source of profit, it comes from the interest received on loans. So the bank, how they are making profit? Out of the interest which is received on loans. Bank has to employ its funds so as to earn sufficient profit to meet its expenses and to pay dividend to its shareholders. So why they want profit? Mainly to meet the expenses. Also they have to pay dividend to their shareholders. See, if you are a bank, people, they have invested on your financial institutions share. So for them, definitely you have to pay dividend. If it is share, you'll be paying dividend. If it is debenture, you'll be paying interest. So in order to meet all these things, you need profit. That comes under profitability. Next is security. So as a banker, he must make sure that there is a surety or any collateral which has been given by the customer. It must be adequate, easily realizable, and free from prior charges. So that comes under security. Purpose of loan. So before granting loan, as a banker, he must inquire the customer in order to have safety of funds. See, if I am a banker and if you are a customer and if you have approached for loan, I have to inquire. Why? Because if you are not able to repay back the loan, again it is a burden for the banker. I will be considering that under NPA, which should not be done so, right? So I have to inquire and I have to make sure that it will be productive. Wherein if you make profit, then definitely you will be repaying loan to me. So this is what the strategy is behind this purpose of loan. You are a customer, you have taken loan, and if you are making profit, then definitely you will be repaying back my money. If it is not productive, if you are not able to make any profit, then how you can repay the loan back? So this comes under inquiring about or making verification or getting to know about the purpose of loan which will be borrowed by the borrower or customer. Diversification of risk. The banker should not lend a major portion of his loanable fund to any single borrower. The banker has to grant moderate loan to large number of customers in order to diversify risk. See, if it is in case of finance, we'll say if it is about diversification of risk, as a company, they'll not be investing on one venture, they'll invest on different ventures. Whereas in case of banking terminology, if it is about diversification of risk, I'll be granting loan to n number of customers. So moderate loan will be granted to large customers. I will not be considering only single customer. Even though if he is financially stable, he is a reputed person, I should not lend loan to the single borrower. Why? Because in case if he fails to repay the debt amount, again it will be a burden for me. If the risk has been diversified, instead of giving 1 crore to one person, I can give 10 lakhs to 10 members. Whereas if the person who has taken 1 crore, if he fails to repay the debt amount, it is a huge burden for the banker. If out of the 10 members where I've granted the 10 lakhs, if one person or two-person fails to pay the loan amount, it'll not be a huge burden for me. Just calculate for the amount 1 crore and just take the count of rupees 20 lakhs. So that comes under diversification of risk. I am diversifying my risk. I am just channelizing it. I am not considering only the single borrower. That comes under diversification. Assured repayment. This is very similar to your safety and security. A banker should come forward to lend money only when the repayment is assured. So you must make sure that you are giving safety, you are providing collateral or surety. Social objectives, as a banker, it is not that they'll be considering only making profits. They also have to give importance to the neglected sectors of the economy. It is not that he's a reputed person and I'll be providing a loan only to that person so that he can repay, or he's having a good financial status, he's financially stable. As a banker, he cannot do so. He has to consider the neglected sector or economy as well. That comes under social objectives. LLA, this we have already discussed in our unit 2, which means a debt will become a bad debt after the expiry of 3 years from the date of loan. This is what the Law of Limitation Act suggests. Recent concepts. So bank are catalyst agent in catering to the better needs of development in conformation with the national objects. It is not only that they'll be making profit, they'll consider the neglected sectors of the economy. They also have to consider the better needs of development. They should concentrate on the national objects. A sound credit is one where timely repayment is assured. So the banker should consider the productivity of the loan as the chief criteria. So this comes under the recent concepts of sound lending.